we're going to kick things off here. I'm going to start off with the disclaimer, which is always everyone's favorite part of the presentation here. This content has been prepared by MacroVisor and is presented for informational purposes only. MacroVisor is not a broker-dealer and does not provide investment advice to individuals. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle. So that is the context here. We want to make sure everyone's aware. These are our ideas. These are some of the strategies we're sharing. It may or may not fit with your risk appetites or your goals, but we want to share these because our goal is to look at the big picture and drill down into themes that we find to be investable and tradable. So let's talk a little bit about the agenda here. We're going to go over the general global macro themes, the United States, Europe, Asia, Latin America, the Middle East and Africa, and then opportunities and asset allocation that we see based on our view. Ayesha, why don't you kick us off?
Thank you. So the global macro backdrop for this quarter is characterized by the global easing cycle, business activity recovery, and the reflation trade, or rather reacceleration of inflation. So what we're seeing is countries have now reached peak rates, with the exception of a few, of course, and rate hikes are largely behind us. So as you can see, 73% of the world is looking at rate cuts by the end of this quarter. Now, emerging markets have already started their easing cycle, although some continue to remain on pause, delaying cuts for fear of inflation coming back. And we'll see some of those examples as we go along. In terms of recovery, what we're seeing is the global PMIs are improving. So as you all know, PMIs are survey data which shows, which talks about business activity. And as you can see, there's an inflection here. So above 50 is expansionary. And so global composite PMI and global manufacturing PMI are both now in expansionary territories. This will likely put some upward pressure on prices as well, because there's going to be more demand for goods and services. And therefore, we might see prices increase as well.
Yeah, let's talk a little bit about those price pressures too. We see a lot of signs that inflation has risen and could continue to rise. This reacceleration of inflation theme has driven some of our investment strategy and ideas as well, because there are beneficiaries. In any type of environment, there will be leading sectors, industries, regions, and other asset classes that we find can outperform the broader market. So if we look at this, contextualize it just by commodity prices, many commodity indices are up over 15% from their quarter four 2023 lows. And we've seen crude oil rally over 20% year to date. We've seen a number of other commodities, softs, energy, metals really coming to life. Copper, gold, silver. Obviously, everyone knows about cocoa, but coffee is starting to follow a similar path. And this has given us some ideas. And we've also seen this in freight rates, which remain elevated, even though they have dropped due to the increased tension in the Red Sea. And that means that this pass-through pressure can take some time, anywhere between 6 and 12 months as contracts are renegotiated. That creates additional price pressure. We also got the NFIB survey of small businesses. Their biggest concern right now, and the lack of confidence they're showing, which is the lowest in something like 11, 12 years, is due to inflation. Many of these same businesses, to deal with that, are planning to raise prices, which creates some pass-through pressure as well. We also see El Nino weather patterns have begun to put pressure on key commodities, including cocoa, coffee, but we may also see pressure in wheat, corn, and soy because of these erratic weather patterns. So let's talk a little bit about commodity prices. I discussed how these indices have surged about 15% off their Q4 lows. We do see more upside here. If you think about it from the perspective of supply and demand, commodity prices just sort of being a very long-term auction, there's likely to be more demand in an environment where central banks are pivoting around the world from hiking to easing. and there's fiscal stimulus that could follow along. This could drive up goods demand, and we certainly can see that when we look at global manufacturing PMIs starting to come back as well. And that feeds into some of the themes that we'll talk about as potential investments as we go on. But for the here and now, this means that the inflation story, that genie being back in the bottle, the idea of everything's transitory, we might have to walk that back a little bit. It's already affecting the outlook regarding the Fed's policy this year, but it's also affecting the expectations of companies and investors. And that's where we start to see this turnabout and the potential to opportunistically allocate. We also see, of course, energy prices continue to rise with a backdrop of escalating geopolitical tensions and rising demand with constrained supply. And we are still bullish on that space, and we have some ideas there to share as well. On the other side, we talked a little bit about price pressures. They are rising again for companies as well. We can see that on the chart on the right-hand side from S&P Global, which shows commodity prices are starting to push up price pressures for companies. And we are likely in the earlier stages of this, but again, it does spell opportunity. So let's quickly go over other global themes and focus here. We have rising geopolitical tensions. We all know about what's going on there. We have tensions in Israel. That potential situation now escalating. It may be that there's a more back and forth direct military conflict between Iran and Israel, which could spark tensions throughout the region. We also have the escalating tensions in Haiti and Ukraine looking more precarious, more likely to potentially fall to Russia now with the lack of U.S. military aid. We have trade sanctions. And these trade sanctions are intensifying on Russia. And the situation with China, it still remains tenuous. There is still talk from this administration. In fact, Yellen was over in China speaking recently, sort of saying, we don't want you dumping your cheap goods in our market. There's still signs that those tensions have not been ameliorated. Now, in those situations, there are always beneficiaries. We'll talk a little bit about that later as well. We also have elections and political changes. Did you know 2024 is a year where the most people by percentage and population are voting for new leadership ever before in human history? That's the year we're in. That means political propaganda will be on the rise, but it also means we have regime changes. And that could have some big effects. In fact, we saw some problems happening with the majority in South Korea, losing that majority, many offering to step down as a result. And that's sort of this ongoing theme. We also had a surprise election result in Turkey that not many had expected. We also have nearshoring and reshoring. And this is one of those themes where more and more countries don't want to have all their manufacturing capacity focused in places like China. So they're diversifying. Industries are moving to Vietnam, Mexico, Malaysia, Indonesia, Philippines, and elsewhere to try to diversify their supply chains. So let's shift over to oil, Ayesha. Talk a little bit more about what's going on there.
Absolutely. So crude oil is central to the inflation and recovery story, right? Now, we know that OPEC production cuts will continue for this second quarter, so there's no big surprise there anymore. But we still remain bullish on energy and oil prices based on undersupply compared to increasing demand. As we rightly saw that, demand is increasing, activity is increasing, and, the manufacturing cycle itself is improving. Right. The other factor is obviously geopolitical risks. We're seeing that today and during this last 1 week, where we've seen, tensions in the Middle East, possible escalations there, which could lead to, further pressure, upward pressure on oil prices. But let's not readily discount Russia yet as well, because the week before we saw attacks, in Russia, which also pushed oil prices up. And now many of these OPEC countries who were not sticking to the production quotas are actually starting to stick to the production quotas. And that's sort of putting supply pressures in place for crude oil. Now, if there is a geopolitical escalation, we're likely to, and if we see a disruption in the Strait of Hormuz, which is very close to Iran and close to us in the UAE, we could actually see oil prices increase by 20%. And that could mean Brent crude prices crosses $100 per barrel. And that's not going to be good by any means. A protracted escalation could mean $100, $120, even $140 per barrel price for for Brent crude. We don't see that coming readily, but it remains a risk for sure. The US, however, has the option to release from the SPR. So, what we can see right now is that the US actually has built up some stock in the SPR. They can release about 60 million barrels, and they're likely to do some of that if oil prices remain high, particularly ahead of the summer season and the driving season. So, at the end of the quarter, what we will be looking out for is a decision from the OPEC on whether they will extend these cuts for the next quarter or until the end of the year. In our opinion, it seems unlikely that they will extend the increased cuts, mainly because they have a lot of spare capacity built up right now, and they need to deploy some of that. And we'll see the effect of these production cuts on the OPEC countries, on one of the OPEC countries, which will tell you why they might think about actually restarting their production and improving the situation. But for the rest of the year, what we do think is that supply still remains lower than demand. And so therefore, we will continue to see price pressures until the end of the year. And with that, I think we can move on to our first country, which is the US.
Yeah, let's take it to the United States. Our key theme in the country is reflation. And it's interesting because, we did have this inflation on vacation theme for a while, but it's coming back. And animal spirits are being reinvigorated because the Fed is talking about cutting while inflation is actually rising. This is a little bit unusual. We all know the Fed's dual mandate. The Fed's dual mandate is price stability and maximum employment. We don't have price stability, but we are quite close to maximum employment, which kind of calls into question why it is that they might want to supersize inflation. That's one of the concerns that we're bringing up here because we do see signs, and last month's CPI data also came in headline 0.4%. So continuing that trend, half of that increase year over year was attributed to forces like energy and services like shelter. What does that tell us? It tells us we're not yet through the trough, right? We still have more room for inflation to potentially rise before it bottoms out at some point, potentially. The Fed, their policy mistake here would be to cut into an environment of near record high stock prices, real estate prices, crypto prices, gold prices, all of these things telling us there is no real near-term need to do that. We have financial conditions that are looser now than before the Fed started their tightening process, which further tells us the fiscal dominance side is really a key component of the demand durability that we've seen through one of the most aggressive hiking cycles the Fed has ever done. So for us, what we're looking at is the Fed potentially supersizing inflation. And I don't know that it's necessarily something that they want to have happen, but when you look at the amount of deficit spending that the US government is doing, as well as the amount of duration parked on bank balance sheets, there is an impetus to this. That is to say, there are reasons for the Fed to slow down the shrinking of their balance sheet while simultaneously cutting rates. It's just not reasons that are spelled out by their dual mandate, but to us spell out a potential policy mistake. And so that's something that we're very much focused on as we look at this situation and navigate throughout 2024, that any cuts here, even the talk of cuts, could reinvigorate further acceleration of inflation.
Yeah, that doesn't sound like, the best situation. And speaking of which, let's talk about the consumer a little bit. So we all know that people built up a lot of savings during the pandemic, and you can see the spike here in the chart. Unfortunately, much of those excess savings have been spent now, and the consumer spending is definitely slowing. So we're seeing savings decline, particularly for the low-income consumer. People are actually dipping into their savings to spend. And again, we see this as a K-shaped economy, where the spending is coming from the top 25% versus the low-income consumer. So things are hard for people. Even today, JP Morgan kind of spoke about this, where they said, cash buffers are normalizing for the consumer. So they continue to say the consumer is strong. And one reason banks like JP Morgan actually say that is because they tend to have the higher income cohort among their consumers versus, the regional banks and some of the more I want to say local banks that have the lower income or who bank the lower income customers, right? And so we will see this divide among, the bigger banks saying the customer is still strong or the consumer is still strong. But the truth is we are seeing those cash buffers normalize, as they say, and we are seeing people dipping into savings in order to spend.
Great. All right. Let's move forward to our next theme here, the resilient economy. GDP growth is expected to slow in Q1 2024 and Q2 2024 below levels that we saw in 2023. This deceleration having everything to do with government spend starting to roll off a bit, the consumer starting to slow down a bit. You can see the high-end consumer pulling back to some degree. That is a concern that we've discussed a little bit. We've seen it in earnings and outlooks from companies like Lululemon and Ulta and otherwise. And so that tells us a little bit that, even though they've been part of the support for this economy to continue expanding, that there is some weakening happening here. And it is something to, I think, pay close attention to as we navigate throughout 2024, that we could see this economy slow. And even though it has been quite resilient, we're not forecasting for an imminent recession or anything like that. We do believe a slowdown is in the cards here. So that is something to pay attention to. We'll obviously get some more clues about that with Q1 earnings season, both in terms of what happened and what they're guiding for. Bank earnings today, which Ayesha will cover a little bit more, but at least give us a sense that guidance is a little softer than what the market was expecting, kind of foreshadowing, if you will. It's also an election year. That does mean that this government, this administration, who's very content to win the election, may continue to do things that are stimulative, that are within their power to do so. Continuing forgiveness of student loans, ratcheting up spending on the Inflation Reduction Act, and the Chips and Science Act are possibilities on the right tail that we need to be aware of. The current deficit spending is the highest percentage of GDP with unemployment as low as it is that we've ever seen in the history of this country, which suggests late cycle excess. That is another risk that amplifies the potential for a reacceleration of inflation. If you look at classical economic theory, they would say never, ever, ever do this. Wait until a recession. You're going to need that capital then. But let the economy find its own way. Don't step in too aggressively in the later cycle, because it's unfortunately it becomes more likely that you could overheat things. It becomes more likely that that overheating would be expressed in terms of prices reaccelerating. And with the fiscal side and the monetary side both shifting more and more towards easing, particularly on the monetary side, that amplifies that risk, in our opinion. We also look at the labor market gradually easing. Quits are falling. Job openings are also falling, but there are still 1.36 jobs available for every unemployed and insured person seeking work, which illustrates that just at the top level, again, we have maximum employment. By the metrics that the Fed looks at, we are pretty darn close to a very tight labor market. Wages also continue to rise at a rate that is appreciably higher than what would give Powell comfort, at 4.1% year over year. So that is also giving us a sense that, again, this is a situation where if wages continue to rise at this rate, prices can continue to rise as well. Because what do companies have to do if they're paying more for their input costs? Eventually, after they take enough margin compression, they need to pass that on. That's what's called cost push inflation, and that does remain a risk. We're not talking about a wage price spiral here by any means. We're just talking about continued upward pressure.
And then on to earnings season, which started today, actually, with the banks kicking off earnings as usual. Now, this earnings season may not be as strong as previously expected, and things could start to get a little spicy here, because we all know that big tech is priced for perfection. right? So what I mean is all these, estimates that we have for big tech, while many of them have been taken down quite a bit, they are still pretty high in the context of things, right? And so we know that if big tech starts missing earnings, that's going to create a lot of pressure on the market. Thus far, things have been good. Big tech has been delivering, largely delivering, I want to say. And, the market has received that well. But that's not to say that this has to continue. Now, the good thing is we are seeing PMIs increase. And with that, we're likely to see EPS increase as well. And we actually need that if we want the stock market rally to be sustainable. Now, earnings growth is still expected to come in positive, but now the forecast is down to 3.6% year on year in terms of EPS growth from 5.8% in December. So that's a big decline or a big re-rating in the earnings outlook here. So we think the slowdown in spending will also start to show up, but the reinflation or the reflation trade will rather show up in numbers in the next quarter, right? So this quarter, we're not likely to see a lot of, the price increases come through. And I think that will be more of a concern for next quarter and the second half of the year. And that may actually push earnings up quite a bit. Just because we got bank earnings already today, I wanted to talk a little bit about that. So from JP Morgan, what we saw, or the biggest thing we saw, is sequentially, their net interest margins actually came down. Now, this is something that Jamie Dimon has actually been warning about. He actually talked about banks over-earning over the last few quarters because of interest rates going up. In terms of deposits, they aren't seeing a lot of migration. When we say migration, what we mean is people moving money from the current account into long-term deposits or fixed deposits. So that hasn't changed as much. So that's probably another sign that people don't have excess cash anymore to move into deposit accounts. So people are keeping them in their current accounts for spending on a day-to-day basis. So everything considered, today wasn't a great start to earnings season. I know BlackRock, kind of topped all their estimates, and I think they said they've crossed 10 trillion in assets under management, which is amazing because we do know there's a lot of money floating around the world, but there are pressures there, right? And sooner or later, some of that will start to come down. Again, don't forget, much of the BlackRock money is also people who benefited from the wealth effect and not the regular or the everyday consumer, right? These are people who have the wherewithal to invest, to save. They have enough excess savings to put away, right? So we are seeing this disconnect between the high-income consumer and the low-income consumer. And that's something to always keep in mind, because that's why some metrics always seem to look very nice. Whereas under the surface, if you start digging deeper, you'll see that things are getting a little bit distorted, and the economy is weakening to a certain extent. Not saying we're going into a recession, but it is. It's not as rosy as everybody thinks it is. Let's put it that way.
Very good. Yeah, it's definitely an environment where some degree of caution is warranted. Let's talk about that in the sense of AI, because I think this is an area that has been very, very driven by hype to some degree. Now, there are real beneficiaries in AI, don't get me wrong. You've got to look at it kind of like the gold rush. In the gold rush, the folks that were selling the picks and the shovels made more money than the prospectors. They were selling the tools to fulfill the dream. But the dream was relatively hard to fulfill because finding gold wasn't necessarily as easy as people thought it would be. This has a lot of parallels with what we're seeing. You can say NVIDIA is one of those pick and shovel sellers. So was Supermicro and Dell and Microsoft and others. They're kind of the platforms in which a lot of these things are built on in the hardware and software sense, respectively. On the other side of that, however, when you look at the companies that are employing AI, you're not necessarily seeing that immediate return on investment. We've had this as a theme for at least a year and a quarter, and yet we're not yet hearing companies widely attribute gains in productivity or margin expansion to the usage of AI. That's important to take into context, because until we see that, we're still sort of at what the Gartner hype cycle says is the peak of inflated expectations, which is to say people expect this to transcend the world into a time of much greater productivity, of much greater profitability, and sadly, much less humans to do the same amount of work, which means less jobs available, potentially, yet that promise is not yet really fully being realized. So it's just something to take into consideration when we hear about AI toothbrushes and AI prepared fast food and AI in your car and AI in your headphones and AI in everything. It almost becomes a little bit much. There was a new device launched recently by Humane called the AI Pin, and it universally received poor reviews. It's an expensive device. It costs like $600. There's a $25 a month subscription. And every single company that looked at it said, I think we'll take a pass on this one. So that's just telling us that, it's sort of like the Internet of Things. Remember when everything had to be online, your dishwasher, your microwave, your washing machine? For some reason, it was helpful to have these things online. And then what we later realized was we were just magnifying the attack surface for hackers to compromise devices. And they benefited from the Internet of so-called vulnerable things more than any of the folks that were really using it. Obviously, there are industrial applications that had some potential use cases, but this is sort of like AI right now. It's being applied to everything, but the actual constructive use cases may be a bit more narrow. So that's something to take into consideration as we look for Q1 earnings. How many companies are saying, you know what, we're absolutely crushing it this year because of AI. If we don't hear that, then we still remain a little cautious outside of the pick and shovel sellers, where there has been a lot of excitement and some of it has been warranted. So that's something that we're going to be keeping an eye on. And it actually is an interesting situation overall, because if AI does continue to scale, it could bring on some other opportunities that we'll talk about in a later slide. But first, let's talk about equity positioning. Now, we did get NAAIM yesterday. It did come down a little bit more, but it's still elevated. It's still elevated on a number of different measures. So whether we're looking at positioning by systematic funds, by money managers, by retail, or otherwise, this positioning is near some of the highest levels that we've seen in years. It's a little bit concerning because a lot of that positioning is very concentrated in the Magnificent Seven names. So if there's any material risk-off event, particularly in earnings season, where the potential for those event volatility catalysts to be amplified happens, that could have deleterious impacts. We have these companies really making up about 30% of the S&P, over 40% of the NASDAQ. So we know that if they do have a risk-off moment, that can pull the markets down. Just like if they have a risk-on moment, like Apple yesterday and NVIDIA, they can pull the markets up really by themselves. It was really the Mag 7 kind of rescuing the markets yesterday. And so to us, we look at that concentration as a tail risk in both directions, but we do believe the Mag 7 earnings are set to slow, and the inglorious 493 may be set to come back. And so that does give us some other ideas for where we may want to allocate into this market. One of those ideas is utilities, which we'll talk about a little later, but let's just go over it in broad strokes. Reshoring, data center growth, and EV charging needs are all driving increased utility scale demand for electricity. We believe that this presents a long-term investing opportunity in utilities, as both increasing generation and transmission should benefit the sector. We also believe that these are long-term trends. If we look at the forecasts, last year, the forecast for long-term energy demand doubled from 2022. Now, what is that telling you? It's telling you that all of this additional activity in manufacturing and data centers, some of which is driven by AI, is for the first time in a very long time, significantly increasing the amount of demand on the grid, which means we need energy and we need it yesterday. And we need it from every source possible. It's not just going to be solar or wind. It is going to be hydrocarbons as well. And there's going to be a number of beneficiaries here. And that plays into some of the themes that we're going to talk about for our investment allocation strategy. But before we get there, let's go across the pond to Europe.
So the risks for Europe are actually far more balanced than in the US. Quite interesting. One would have never thought that the Europe would actually be more balanced. So inflation has abated significantly in the euro, and energy actually played a huge part in inflation. So with inflation, with energy coming down or the energy prices coming down, we're seeing that drag in inflation, and we're seeing prices come down drastically. But in the UK, inflation still remains quite high, and in fact higher than the US or the euro area. Now, rising oil prices is still a concern for the euro area, but gas prices are more relevant for them. And as you can see from the second chart here, we're not even close to peak levels. So it's not as much of a concern anymore. We remain bullish on equities here, particularly for the euro area, as activity is picking up. As you can see, we're still many of the PMIs are still in contractionary territory, but we are seeing the cycle. We were seeing the cycle bottom and now inflecting upwards, right? And this will start to see improvement in GDP numbers as well. Now, wage pressures is something that the euro area and the UK is looking at. And what we're seeing is early wage trackers are showing us that some of that is also coming down. Those pressures are also coming down. And the ECB confirmed, or let's say almost confirmed, June as being their target for the first rate cut. Now, for the UK, though, we think August is more plausible because inflation still remains quite sticky and we are seeing prices go up. So, for example, we see nationwide housing prices picking up here again. So they want to be a little bit more careful. We've had a few Bank of England speakers come out and say it's better to hold rates higher for longer rather than having to hike again after the first cut. So I think there will be some caution over there. The other thing that we want to keep an eye on is goods prices, mainly because we're seeing freight rates come under pressure because of the Red Sea issue, because of the escalation in the Middle East. Well, there is some escalation there. And so we might actually see goods prices go up once again. Add to that manufacturing picking up, commodity prices picking up, and everything combined. And if inflation returns to China, which we are seeing slightly, we might actually see more goods pressure there once again. So something to keep an eye on. But on the whole, I think for this quarter, we remain bullish of equities. Next up, we have Asia. So under Asia, we cover quite a few countries. And what we're seeing is that the overall theme in Asia is inflation is actually quite sticky. So let's start off with Japan. Now, we have the major BOJ hike event behind us now, and we don't see another hike until the third quarter. So we're free and clear for the second quarter. Conditions remain easy with bond purchases, and that is sort of fueling equities here once again. But we think higher wages will start to show up in the numbers. So we're going to watch the numbers this earnings season, and we might actually see some of those higher wages put pressure on costs and therefore the bottom line. Now, in terms of GDP growth, we did see a negative quarter, and thereafter the final numbers did come in positive. So initially we thought Japan had slipped into a recession, but now it would seem that they narrowly avoided a recession. But we think that GDP growth remains low, and so does industrial activity, which will kind of put pressure on equities as well. Now, we're watching the yen because we've been seeing this remain at sort of intervention levels at 152, like above 152, even now at 153. And we don't know which way it's going to turn because it doesn't seem that the government is ready and willing immediately to take intervention measures right away. So the good thing about the yen being weak for Japan is that it ushers in inflation for them, something that they want, right? So that's been the biggest sticking point here, whether inflation takes hold or not in Japan. And one way to make sure that inflation does take hold is to keep the currency weak for a while until these wage hikes actually kick in and there is consumption driving inflation versus external factors driving inflation. So for this quarter, we're actually neutral on equities for Japan because it's a little bit of a tricky situation given that we do have pressures across the board. And then we look at China. So China is very interesting. We're still worried about China in the long term, and we're not seeing the kind of support from the government to maintain long-term stability. Now, the government has their eyes on more sophisticated manufacturing and more sophisticated goods production here. They've ushered in this slogan of from made in China to made by China. So they want to, take part in some of the more advanced manufacturing lines. Now, short term, however, we are seeing some momentum pick up in equities, mainly because we're seeing some improvement in the macro data. So we're seeing the cycle inflect here a little bit. So we can see the PMIs in the first chart, which shows that we are coming off the bottom, right? And we are now in expansionary territory for manufacturing PMIs. We're seeing some inflation there as well. So this month they printed their second inflation print from a deflationary situation. But then again, today we got export data, which fell much more than expected. So still some concerns in China, I would say, even short term, but the cycle is turning. And therefore, we can be short-term bullish on equity. In the long term, however, we want to remain cautious because they are still in this debt deflation spiral and the government is not doing enough, right? So they are willing to accept lower growth rates, much lower. So they're targeting 5% versus their long-run average of 8.7%, which will definitely put pressure on equities in the long run. And consumption has not picked up the way it should. So in the long run, our opinion is we don't invest there just yet. But for the short term, it could be a good trade. Now, next up, we have India. So India, we continue to remain bullish on India, but also cautious again. Mainly because elections are coming up, plus earnings season is also coming up. And so we may see some volatility there and some, pullbacks along the way. So we expect the central bank to continue holding rates this quarter because food inflation keeps going higher and higher. So as you can see, we've marked off food inflation there and we're seeing an inflection again. And all of this has to do with the El Nino weather patterns that we talked about earlier. Now, a good way to measure this is tractor sales. And as you can see, we're seeing a decline in tractor sales year on. So basically, food production, agricultural production is tight and there are shortages there. Now, GDP growth has remained strong. We might see some declines in GDP growth because it's been enormously strong. And a lot of that strength was driven by government expenditure. Consumption from the top 10% still remains key. So again, India is another country where the K-shaped economy is very, very prominent, actually more prominent than most other economies where only the top 10% actually drives a lot of the consumption. So rural poverty is still a concern here. And therefore, we might see a slowdown there as well. Now, we think that Prime Minister Modi will likely win again. But there are some questions around his popularity, again, because of this divide among the rich and, much of the population who's benefiting from the trickle-down effects, but not so much from their, from agricultural production or for improvement in their own lifestyles. But overall, India is a country of growth. In the long term, we do expect GDP to remain stable and growing. We expect expansion, and they have a massive focus on digitization, which I think will also usher in a whole new era for them. So overall, country's doing well, and we remain bullish.
And let's move on to two other countries in Asia on this slide that we've had our eyes on. We actually expanded coverage recently into Malaysia, and we have been covering Philippines for some time. Both countries have somewhat different trajectories. Starting off with Malaysia, Malaysia's economy contracted by 2.1% in the fourth quarter of 2023 after registering a strong Q3. This does have us a little concerned, particularly because external demand has been dragging. And Malaysia does a lot of business with China. China is really their second largest export destination. So however the Chinese consumer is doing, however Chinese exports are doing, those two variables have a big effect on demand for Malaysian exports. And we can see China's not recovering the way that we would hope on those two metrics. So it does put some pressure on Malaysia. We can also see that in industrial production month over month. We had a big contraction recently. So we are a bit cautious here overall. But if China does show signs of coming back, that could help to rekindle growth in Malaysia. Malaysia's manufacturing industry has actually been in contraction since September of 2022. The most recent reading of manufacturing PMIs has it close to even. But we're still in a kind of precarious state. We're basically waiting to see whether or not China is willing to go to further lengths to stimulate their economy, to rekindle internal consumption, and also to make their exports more attractive, which probably means some degree of further currency devaluation. Another interesting fact with Malaysia is inflation in the country is actually quite low. So if they did want to cut earlier than they had planned, they could. They could cut this year. Now, the central bank has said they don't have any plans to cut this year, so they may not. So this is why we're a little more cautious on Malaysia here. For the Philippines, we see that exports are seeing a significant recovery. You can see that in the year-over-year numbers that we got for February, and that recovery may be set to continue. But we do temper our enthusiasm because rising geopolitical tensions with China could harm exports. And China, combined with Hong Kong, which is essentially a satellite of China, are the largest export destinations for goods when combined for the country by a lot. So we are neutral on Philippines equities exposure in Q2. We look at the potential for this to become more bullish if those geopolitical tensions with China do not rise, and if China, like Malaysia, is able to continue to stimulate their economy in ways that translates to the numbers. I would say we're more constructive on Philippines than Malaysia, still long-term constructive on Philippines, and still cautious on Malaysia long-term until we see that turnabout. The other thing is inflation in the Philippines remains a concern. That's likely to keep the central bank on hold for now. So really what we want to be watching most closely for the Philippines to see whether or not it's time to turn bullish is that return of demand, strong demand from China and Hong Kong, tempering inflation, and more talk from the central bank that they're willing to start cutting rates. Until we start seeing those all line up, we're still a little cautious here. Let's move over to South Korea and Vietnam. South Korea, we've heard a lot of headlines from. Their political situation could cause some near-term bumpiness because we've had this sort of upheaval of the ruling party. Many have offered to resign after they lost the majority. And whenever that happens in a country, it tends to create some gridlock, and that could slow things down in the economy a little bit. Remember, South Korea is a big exporter. Semiconductors, heavy machinery, automobiles, all that is a big part of what they're sending out to the rest of the world. So the demand for those specific exports is really key to this country's turnaround story. If we do see emerging markets cutting rates and that stimulates goods demand followed by developed countries cutting rates and goods demand adding on to that from there, that would be a very bullish scenario for South Korea. And we can see their manufacturing industry has been expanding year over year since August of last year. So the Korean situation, we're still constructive there, but we're a little more cautious after the political upheaval. And we are still awaiting the real stimulative cutting cycle, that creation of a new credit cycle by global central banks to take hold and provide that additional boost to goods demand. Nevertheless, for a Q2 outlook, we would be bullish on South Korean equities, particularly in comparison to places like Malaysia and Philippines, where the certainty of South Korea's expansion is a little stronger. Vietnam is also an interesting place. We recently published a free article for everyone to look at about our outlook for Vietnam over the next 5 or 10 years. Looking ahead in quarter two, that outlook remains pretty solid. The key points here are foreign direct investment continues to grow. It grew by 32% last year, which is enormous. And we see 15 large US companies talking about increasing their foreign direct investment this year by as much as $8 billion, including adding semiconductor production to Vietnam, which would be very interesting because this would again further diversify our supply chains in one of the most key areas of the global economy. Vietnam has also been a beneficiary of trade tensions where the world is trying to reshore, nearshore, and basically get away from China wherever is possible. So we see a lot more textiles, small electronics, and other kinds of goods, being produced in Vietnam and moving away from China. We've also heard from major companies like Nike moving production into Vietnam and away from China. We believe this is an ongoing theme, and it's one that could play out over many years to come, and Q2 is a part of that cycle. We also like seeing growing domestic consumption, a building middle class in Vietnam, and tourism, which is one of the key areas of growth for the economy, remaining robust. Adding to that positivity on Vietnam, reduced capital controls and positive regulatory reform that makes it easier for international investors to invest directly in the country. Ayesha, let's move on to Latin America here. We've got a couple of economies that we want to talk about that we've been covering. One of which has created a bit of controversy for one reason or another, is Mexico. Of course, the rumor is everyone's just relabeling everything. And it's coming from China, and they're just relabeling it as made in Mexico, and somehow that's averting all of the tariffs, and that's the whole story there. We take issue with that view. Our research indicates there's a real renaissance in manufacturing happening in Mexico, and you can see it with record low unemployment. You can see it with foreign direct investment surging. You can see it with the exports of key industrial goods made in Mexico, not relabeled in Mexico, coming to the United States. And think about it. If you're an international company and you're saying, you know what, I learned my lesson in 2020 and 2021 and 2022 about the international supply chain's fragility and just-in-time inventory and, sending things from the other side of the world. I want things closer to home. I don't want them traveling, all these miles over the ocean, especially with rising geopolitical tensions. Well, guess what? Mexico has the largest access to the United States outside of Canada. They have direct land-to-land access to southern United States, which is where an enormous amount of goods are coming in. They're not coming in by sea nearly as much. This gives Mexico a key advantage because if you want to talk about being able to get your inventory in a predictable time frame, this is much better than sending it over the sea from China. The other thing that we're seeing in Mexico that resembles what we've seen in Vietnam is a surge of foreign direct investment with a focus on manufacturing. This is part of this global reshoring theme. If you talk about what's happening in Mexico from that context, it's very bullish for their economy, and you've seen it in their stocks. You've seen it in their GDP numbers, in manufacturing becoming a larger part of GDP as GDP expands. And the trade tensions with China, which continue to boil, this is adding more and more desire for companies to put even greater amounts of their manufacturing in Mexico. So we remain very constructive on the country, and it is quite a contrast to our next one, which is Brazil. The new leadership in Brazil, gotta say, we are not fans here. They may have good intentions, they may not. I'm not going to dabble into their politics. I'm only going to say that what we look for are the impacts of policy. And those impacts have been wholly deleterious. The Brazilian GDP has had 2 quarters in a row of 0% growth. That's not a good sign, especially as they're cutting rates and trying to stimulate their economy. And labor woes have impeded major projects in Brazil. Environmental permits are actually paused in key sectors that were driving growth previously, including areas that are incredibly important to the commodity exporter, like oil exploration, mining, and gas pipelines. If you think about that, and how much of the economy in Brazil is driven by these exports, that's really a negative sign. We don't think this administration has really the economy top of mind. It's much more about social issues. It's much more about fulfilling some of these, kind of more socialist campaign promises. And unfortunately for an economy like Brazil, that is going to be deleterious. And it could even hurt some of the key companies that people invest in over there, like Petrobras and Vale. These are areas that we're concerned about because we've seen Lula directly interfere with both companies, telling Petrobras to cut their dividend and return more to the government, and telling both companies he wants to replace their CEOs, which is, again, not what you want to see if you're going to be investing in a country that the president becomes the kingmaker so directly, so obviously, right in your face, and that they also don't have designs that are good for you as the investor, but are more focused on how the government benefits from that. So we're seeing these problems continuing. We believe this is driving capital out of Brazil and to its neighbors, like Colombia and Chile, and a little further away into Mexico. So with that, Ayesha, I'd like to hand it off so we could talk about the Middle East.
Thank you. That's such an interesting divergence. And it shows how the macro and business can be affected by political situations as well, to such a large extent, right? So talking about the Middle East, we have a mixed set of risks over here. We're going to look at Middle East and Africa. We're going to look at 4 countries today. First off, we start with Saudi Arabia. Now, with the cut in oil production, we are seeing negative GDP growth because oil accounts for about over 30% of GDP for Saudi Arabia. So when they did decide to bear the higher brunt of the OPEC cuts, they actually harmed their own economy quite a bit. So something to think about. And then secondly, we have fiscal expenses, which are also an issue because of all these new projects that they're undertaking. And the government actually needs higher oil prices to cover all the planned expenses from their sovereign wealth fund, which is the PIF, which is, and we can see here in the second chart where the fiscal break-even for oil prices is actually quite different with and without these PIF investments. Now, geopolitical tensions also remain a bit of a concern because they are here in the Middle East. But overall, Saudi Arabia's balance sheet remains very strong, and they are rated A. And we do remain bullish on equities here for Saudi Arabia. We might see some pullbacks because of the geopolitical tensions, but we do remain bullish. The second country is South Africa, where we also remain bullish equities here. It's an interesting situation. South Africa has been in a very tough situation for the last few, I want to say, years, with power outages weighing on the economy. Inflation has also been reaccelerating because of food shortages, again, those weather issues, higher energy prices, and a weaker currency. So right now, the situation is such that if the Fed holds rates higher for longer, we're actually going to see a stronger dollar. And that's going to put pressure on a lot of emerging markets and frontier markets because of a stronger dollar. And that might actually bring in more inflation as well into these countries. Elections are likely to be a close fight. So the elections are going to be, I think, on May 29th. And the ruling party may actually get toppled because of all these power outages, which is creating a lot of poverty also in the country. Now, the central bank has remained firm. They have held rates high at 8.5%. They were planning, or most people were thinking that they will cut in May. However, with inflation reaccelerating here, we're likely to see the first cut come in July. However, we are seeing some stable policies coming through. We're seeing some improvement in the power outages. We're seeing some improvement in the GDP growth. And if the government does actually change, that will actually be helpful because there has been quite a lot of social unrest because of the prevailing government. So overall, we do remain bullish on equities here. And finally, we're looking at Turkey and Egypt. Now, Turkey and Egypt remain 2 wild cards in this region, where inflation and policy measures have been absolutely out of control. So Turkey has an inflation rate of 67%. Egypt has an inflation rate of 36%, both year over year. Yes, that is right, 67 and 36%. Now, Turkey, we know the central bank did a surprise hike last, I want to say last month. But they only started their conventional monetary policy early 2023. So prior to that, we know that they were cutting rates as inflation was going up, which is quite an interesting take on how to manage, monetary policy. But they did bring in a new governor who also left, but they started hiking, as you can see in the bottom portion of the chart. Unfortunately, inflation is accelerating again, and this is because the lira has remained weak for the last, I want to say, 2 to 3 quarters. There's food prices are going up again, oil prices are high, and the central bank will likely hike again. But more importantly, the country actually needs to attract more foreign investments. They need more dollars coming into the country, and that should actually help. But overall, we don't have a call on Turkey, neither do we have a call on Egypt. Now, Egypt is a very interesting situation. They had a lot of archaic policies as well. Their central bank was fixing their currencies. But they did get lucky, I want to say, in the last quarter when they had a huge influx of investments coming from the UAE. So they got 35 billion in investments from the UAE and another 5 billion in loans from the IMF. Based on this, what they did is they stopped fixing, or they depegged their currency and they let it float. Now, when they did that, the currency obviously depreciated strongly. It went from 31 in the last fixing to 50. Now, had this investment not come in, this $40 billion, we would have seen probably worse situation with their currency. But this influx of cash has actually stabilized their economy quite a bit. The central bank also did a surprise hike in order to control inflation. But all in all, now they've promised reforms to stabilize growth and control inflation. So both countries are adopting policies that are, let's say, normal and helpful to the country. We need to see them follow through on these policies. So both countries remain on watch. I just thought they would be interesting to take a look at, given their inflation and what's happening in the country. And with that, we're done.
Right. So let's talk about our overall market outlook and opportunities in Q2. So our overarching view is one of reflation, is one of expansion, and is this notion that we'll be in a new credit cycle environment, and there could be key beneficiaries of that in the world, but also in the United States. We know a lot of folks watching are mostly focused on investing in the United States. So one of our goals at MacroVisor is to broaden your horizons so you can find uncorrelated returns going into the areas that maybe are a little less covered. We know also that old economy stocks are still not popular. If you look at investor allocations to areas like energy, industrials, materials, metals and mining, utilities, aerospace and defense, they're lower than where they could and probably should be, and they're very high to some degree because of passive investment preference and active management seeking to beat the market in areas like mega cap tech and growth. So for us, we're seeing the potential for a bit of a rotation. That is to say, there's some catch up to do in these late cycle beneficiaries. We like going into Q2 themes that we've been talking about for several months now: energy, industrials, materials, metals, and mining, and also, for reasons we discussed earlier, utilities. Energy is objectively cheap. It's still one of the most discounted sectors in the S&P. Some of the higher quality energy plays have been some of the biggest gainers this year in these old economy stocks. We believe that's set to continue because they're enjoying margin expansion with the rising price of oil. This is also an area where they are getting much more efficient. Look at rig counts and look at personnel per rig, and then look at oil production. And what you can see is that they're doing more with less. We also have a lot of exploration to do as we try to increase production to meet the demand of a world that has a rising appetite for energy. So that makes us very bullish on the sector. Industrials are an area we're looking at because we believe that infrastructure projects, goods demand, and otherwise are set to continue rising in this environment. So that makes us want to be long the space because we believe that, like energy, there's some objectively cheap areas. And we can also see that on some of the days where we're getting less than ideal data about inflation or upside surprises in the economy, industrials are showing relative strength. That is showing you there's a rotation into that sector. We can see it from hedge fund flows as well. They're early, but they're nibbling and they're continuing to increase their allocation. Materials like industrials are late cycle beneficiaries. They also will do well in an environment where goods demand is picking up in an earlier cycle of cutting. So I'd like to contextualize this by saying the developed markets are still late cycle. The emerging markets are getting into their early cycle. There is a bit of a lack of harmony here, and it has everything to do with how emerging markets were earlier to tighten and are now earlier to cut, and developed markets are sort of catching up to that. So we do believe materials are another space to be bullish of for the same reasons as industrials. And then metals and mining. I'm sure everyone's seen the price of gold, copper, silver, platinum, palladium, all surging year to date. Those are themes that could be set to continue, and that make us very bullish of the space. For example, with copper, our exploration and our existing stocks are woefully insufficient. If copper demand continues to build here due to rising electrification of frontier markets, EV production, more creation of projects for solar and wind, building out data centers, increasing transmission capacity for utilities all over the world, that's wildly bullish for copper. Copper is also broken out of a long-term range of consolidation to the upside, and copper miners have done so with increasing vigor because they have some leverage to the metal. So we're bullish on metals and mining. We still like high-quality silver and gold miners as well. Many of those ideas we have shared, and if you want to check out some of them, our last week's dashboard is completely free for everyone to check out, where we shared many of these ideas with the investing public. And Ayesha, why don't you take us through our dashboard here on some of the areas that we're talking about with our macro view for Q2?
Sure. So every week we publish our dashboard. Now, the first two columns are basically our quarterly outlook. And then the next two columns are basically our week-to-week outlook. So we look at the weekly outlook based on momentum, what these asset classes are basically doing in the short term and where they are likely to go. So we obviously have a color coding system, which should make it very easy. And then for the longer term view, we're just looking at it from a bullish, bearish, or neutral point of view. We take a look at all the macro data, everything we've talked about today, and then we distill that into our views. We actually track these through ETFs so that it's easy for people to kind of invest in them. If they want to, they can take a position if they'd like to. And we publish this every week along with our views of the week ahead.
Absolutely. And so when we talk about some of these select areas that we remain bullish of, or where we have trade ideas to the downside, let's walk through some of them. Currencies, we favor shorting the euro. Let's be real. The ECB is going to cut first. They don't have a choice. Lagarde kind of started to sort of lean more in that direction in recent meetings, but we also know, as Ayesha has aptly discussed for a long time, the European economic area is much more rate sensitive. They do not have the capacity to keep rates as high as they are. And they're not even that comparatively high. If you look at the US, we're quite a bit higher, even if you look at England. Nevertheless, they are likely to cut. And I believe those cuts are going to be coming over the next couple months. We'll start seeing that cycle. So that gives us an idea. Let's short the euro. Let's put some pressure on a currency where it's very likely that we'll see additional downside because of the perceived differential in monetary policy. The Fed, going into this year, expectations were 7 cuts in late December of 2023. Now we're looking at 1.5. That tells you that there's a lot of folks that are still having to adjust to that new reality, which also makes us bullish of the dollar. We're bullish of the dollar because we believe that rates could continue to rise, particularly on the longer end of the curve. There's no term premium on the 10-year. If you're buying a 10-year note right now, you're not getting paid more than someone who's buying 30 days to several months of exposure to bills. which is something that we have some trouble wrapping our heads around, being bullish of the longer duration exposure. So we believe that as that 10-year rises, that can drag the dollar higher. Then we've got emerging market equities. Ayesha, you want to take us through this one?
So it's more or less what we talked about today, right? So our emerging market equities, our favorite ones that we do have kind of quite a bit of conviction on India and Mexico. In terms of sector, I think you gave like a good rundown on the sectors. And in terms of commodities, again, you talked about copper, platinum, silver, wheat, coffee, and crude oil, all very, very interesting sectors. And we think that will remain bullish and we could see some upward price action there.
Absolutely. We're still constructive on that whole commodity space going into the next quarter.
Right. So now in terms of stock picks as well, what we do is we have two kinds of stock picks. We have our long-term investing, which you can see at the bottom, these three names, Chevron, CACI, and Accenture. These are companies that we want to hold for the next 10 to 30 years. So companies basically want to retire with. We have a list of, I want to say 12 to 13 names, and we continue to add names to them as and when we see companies that will remain strong for the long term. And then we have our recent stock picks, and these are more companies that we look at for anywhere between 3 months and 3 years. We may close out a position. So these are not, we don't tell you when to enter or when to exit. These are just ideas, and we do research on them, and we give you our bull case or bear case on them. So we have a whole list of ideas, and which we also update on a weekly basis with our weekly dashboard.
Absolutely. So one of the things that we've been looking at here as a recurring theme is energy. Vital energy was one of our picks earlier this year. I believe that it's performed very well for folks that pursue that. Same with Knife River. And then we look over at some of the select long-term investing picks like Chevron, CACI International, Accenture, pretty diversified group there, all of which are firing on all cylinders and we believe have long-term potential ahead of them. So let's move over here to questions and answers. If anyone has any questions that they'd like to ask us about the presentation, about what we do at MacroVisor, or our views on other markets or economies, you're welcome to ask them here. We'll do our best to answer. And if not, then we'll get back to you as soon as we can.
So while you check the queues, I will read out a question that we got from our emails. What happens if unemployment starts to rise drastically in the US? So excellent question here. We are seeing signs of the employment market sort of weakening. So Mayhem went through that earlier in the slide deck, and we looked at the labor market. There are certain signs where we do see weakness. So the picture that we see, or the results that we see at the top line, are not as well, the market isn't as strong as it seems to be. Now, unemployment, unfortunately, once it starts rising, it can rise very drastically. That's what we've seen in the past. But for that, we need extremely weak GDP conditions, which is not the situation in the US right now. Relatively, there is strength in the US. And so if unemployment starts to rise drastically, we do think that the Fed will decide to cut. They lowered their unemployment target to 4%. The current unemployment rate is at 3.8%. So we are only 0.2% away from their, I want to say their projections, right? The Fed has said time and again that if they see unemployment start to rise drastically, that will bring on a rate cut. So that would be one of the reasons for the Fed cutting rates. Will it be the right thing to do? We don't know. In the face of rising inflation, perhaps not. Perhaps living with a slight amount of unemployment is, while an uncomfortable situation, is possibly better than living with a high level of inflation, which erodes people's wealth, particularly for low-income consumers. So the bottom line is, if unemployment starts to rise drastically, if it does go above the Fed's projections, we're likely to see a cut forthcoming from the Fed.
And Aisha, we just had another question that dovetails nicely into this one. At what level of inflation in the U.S. would you begin to become concerned and become less bullish on some of these areas and sectors that we've discussed today?
That's another great question. So the truth is inflation is rising, but it still remains quite low compared to peak levels, right? Now, at what point would we be concerned? That's a difficult question to answer. Honestly, I have no good answer for that. Mayhem, I don't know if you do, but I don't have a good answer to that. What I do know is inflation will help certain sectors, right? So we've seen EPS, or we've seen revenues, actually, not EPS. We've seen revenues rise while inflation was going up. So when inflation is high or coming down, that's a time when we actually see pressure on equities, or we see pressure on earnings and revenue. When inflation is actually accelerating, that's when the revenues actually start to pick up. So a little bit of inflation acceleration here may actually help revenues, but on the flip side, it's not good for the consumer, and that actually puts a lot of pressure.
So my thought on it, and I appreciate everything you shared, I think that's all good context for what I'm going to say here, is that we need to look at it with a bit of nuance. Just looking at inflation data in a vacuum isn't going to tell us as much, because we don't get a sense as to whether companies have the capacity to pass those prices on and whether they're being well absorbed by the consumer. So for me, the rate of inflation that concerns me has more to do with how we see it impacting company bottom lines. Are they absorbing it and realizing margin loss? If so, that's an area I start to become more concerned. Are they able to pass it on and realize margin stability or growth? Well, then I'm still able to be constructive on U.S. equities or other countries' equities in that situation. So it's more of a multivariable construct. You've got to see what the breaking point is for the consumer, essentially. When they start saying no more, but companies are still seeing rising costs, that's where I would get concerned.
Excellent. That's a great way to look at it. So we have another question. This is an interesting one. I think you'll like it. How far can gold go? Do you want me to add some thoughts?
Yeah, sure. Let me just start off real quick. I've been in and out of gold, trading the precious metal and its higher quality miners since 2006. And I really think that this time is a bit different than some of the other gold rallies that we've seen. The reason I say that is gold is showing incredible resilience to rising nominal rates, a rising dollar, and even real rates picking up a bit. To me, that tells me there's something else driving gold prices beyond some of the conventional reasons to allocate to it. After all, if you think about it, gold is competing with everything that actually has a dividend or pays some kind of yield, right? It is a yieldless speculative precious metal that acts more as a potential store of value or a hedge against uncertainty than any kind of capital appreciation mechanism. It's fair to say that the world is underweight gold. If you look at retail exposure, whether it's of the physical metal or whether it's of the the miners or otherwise, allocations by institutional investors and households are quite low overall. So that tells me there's still room for the metal and the companies that are the higher quality miners like Agnico and the higher quality streamers like Wheaton to continue building into this environment. Franco-Nevada, Royal Gold, those are some of the others we like in the space as well. And so where can it go from here? I would say it's more a matter as to when does uncertainty abate? Because gold is loving uncertainty. That is what's driving it, whether it's geopolitical uncertainty, which continues to rise, whether it's the uncertainty of a forthcoming monetary policy mistake, which is continuing to build, whether it's the uncertainty of global political elections and the lack of visibility as to what the next several years look like. That's also building in America and all over the world. And then we look at it also from another context, which is even though the dollar has been strong versus a lot of other currencies this year, it is still a race to the bottom in purchasing power. We can see that in the inflation data, and that's telling us that gold can appreciate on another basis altogether, and that is just currency debasement overall. So I would say that for me, I'm really looking at this more of, when does the uncertainty fade? When do geopolitical tensions simmer? What does the world look like when we're on the other side of these elections? And does the Fed make that monetary policy mistake, and does it rekindle another bout of inflation acceleration? Those are kind of some of the posts along the way that I'm looking at to get a sense as to when gold may kind of start to fade, and it may be a better time to take off some of these longer term allocations to the metal. For now, I'm still bullish, and I don't really see a ceiling until these things have been alleviated. Now, I will say this. I'm not a gold bug. I'm not calling for $10,000 gold. I'm not calling for the end of the dollar or any kind of shakeup like that. But I am still constructive on the metal, and I'm actually more bullish of silver than gold, because I think silver has a lot of catching up to do, and industrial usage is also rising. And I think that regime of appreciating metals prices could continue for the rest of this year. And we got another question about, why do I like platinum? But before we get to that question, Ayesha, why don't you share your thoughts on gold?
No, you covered it very well. Thank you.
Yeah, absolutely. Thank you. And then for platinum, why do I like platinum? Because platinum is a beneficiary of industrial demand. Platinum is used in cars, it's used in trucks, it's used in semiconductors, it's used in a lot of different processes that we are likely to see demand increasing within. So we believe that platinum, I mean, look, the EV revolution, it's kind of petering out. There's still a lot of demand for internal combustion engines. Platinum is used in a lot of catalytic converters. It's still pretty cheap versus palladium at this point. There's a big rotation to palladium. Now we're kind of seeing folks go back to platinum. The other issue is, hey, things in South Africa, electricity stability, overall geopolitical stability are not great. Which tells me, because it's one of the world's largest platinum producers, that if any of that gets knocked offline, that's a big right tail risk for platinum prices further going higher. Who's another big producer of platinum? None other than Russia. And we don't know where things go from here with regards to trade tensions, tariffs, and other kinds of issues that could emerge. So we also see some signs of supply being constrained as demand is firming up for the metal. So just checking around to see if we have any other questions here. Really great questions, folks. Appreciate you sharing those with us. It looks like we've covered everything, Ayesha. Do you want to share any closing thoughts with our audience as we wrap up?
No, I'm just so happy that everyone could attend. I just want to thank everybody for joining us today. This quarter is definitely shaping up to be quite interesting. We have all kinds of things happening. We have inflation, we have earnings, and we have elections and politics. So everything coming together. And we will continue to cover these events. We will cover deep dives on the countries, not just through our weekly dashboard, but we also do deep dives from time to time. If you want to go back and check the website, we have research on China, we have research on Vietnam, we have research on most of these countries that we've talked about today. And we hope that you've got a good sense of the big picture and where we're headed, and how we drill down from the big picture to come up with opportunities.
Absolutely. We appreciate you all tuning in. If you have any questions about this presentation, about MacroVisor or otherwise, feel free to send us an email to hello@macrovisor.com. Our core ethos at MacroVisor is we find when macro and momentum meet, there is opportunity. So if you'd like to check out our work, visit us on the web at www.macrovisor.com. You can sign up to our free newsletter, and you can also sign up for our premium research. And thank you for tuning in. We'll catch you soon.